I'm Josh Duvall, certified financial planner, registered tax preparer from joshuaduvall.com. And I just wanted to bring you a quick update regarding the Federal Reserve, the most recent minutes from the July meeting, and what tapering means. It's a term you're going to be hearing over the next few months, quarters, and into next year. What tapering means for the stock market, for retirement planning, etc. So just to give you a quick summary and bring you up to speed, obviously it's way more complex than this, but essentially after the financial crisis of 2007, right? So we're going back, the Federal Reserve opened up a broad quantitative easing process. They injected money into the financial system in order to bring about stability after a massive stock market crash, housing crisis, etc. The result of that was a reduction in interest. Well, there was many results. Inflation was a result, but the major one was related to interest rates. So over the last number of years, as the Fed has continued to buy bonds through the federal government, the Federal Reserve buying federal treasuries through the federal government, interest rate has continued to decrease. We know mortgage rates are at like 2.75%, right? So a very, very low relative to where they've been over the last 10 years, 20 years. And if you go back to 30, 40, 50 years ago, you have rates in the teens. So we're historically at very high price of bonds, which is a low interest rate. Again, those are inverse. The concern about tapering as the Federal Reserve starts to show signs that we're going to stop buying federal bonds, U.S. government treasuries, and start restricting money that's flowing into the financial system, there's many concerns related to the stock market. One of them is that interest rates will start to immediately rise. So interest rates are based off of what's called the federal funds rate, which is the rate that large institutions borrow money from each other at, overnight loans. You can go online and learn as much about some of these boring things as you want. But the point that I'm trying to make is that interest rates as a result of tapering are going to start rising again. What does that mean? Well, for someone who's in the short-term interest of buying a home, you're at a historically low point of an interest rate. So there's a really big opportunity to be able to save a significant amount of money on the interest that you're going to pay on a home loan, buying in a low interest rate environment compared to buying in a much higher interest rate environment. Even thinking about a move from 2.75% of an annual interest rate to something like 3.5%, right? On paper, it doesn't seem that much, but when you extend that over the course of 30 years, it's going to make a massive difference in the amount of money you're able to borrow or the size of home that you're able to purchase. The other concern is related to inflation. Inflation, we know, saw a huge spike as a result of COVID stimulus and bottlenecks in the supply chain across the world. In the United States, we've had something like 5% inflation, which means that your money is worth 5% less than it used to be, right? So that relates to purchasing power. There's a concern from officials, from bankers and so forth, that inflation, that 5% rate could kind of become stabilized there as opposed to the Federal Reserve stated goal of about 2% annual inflation. That's significantly higher, right? Like 100% more. So they're concerned about inflation staying in that 4 to 5% range, which obviously decreases purchasing power and can cause lots of other issues in the economy. The final thing that they're worried about related to tapering is what would happen with asset prices that might be artificially inflated. So there's always a concern about the stock market. There's a never-ending, they're called perma bears, people that always only see negatives of where the stock market is at and all the risks, right? The old saying is that Wall Street climbs a wall of worry, meaning no matter what the concerns are, Taliban, deterioration in the Middle East, obviously there's a potential with the 20-year anniversary of September 11th coming up that there's some sort of United States-based or global-based terrorist attack, which would send markets reeling. Obviously, we have all the concerns related to COVID, the economy related to vaccine passports, lockdowns, all those things. There's plenty of reasons to be skeptical, yet the stock market, if you look back at a low of during COVID, when the market fell off 20+% kind of overnight, we're way past that mark, right? So in fact, some client portfolios have literally gained 20% over the course of year to date. In their investment portfolio. So there's something to be said about the reality that yes, there are concerns related to COVID. Yes, there are concerns related to tapering. The big question is, well, what does that mean for you specifically? So when you get online, you look at headlines and hear things about the Federal Reserve and tapering of the bond purchasing program and restrictive money flow and increased interest rates and inflation. And you think about all these things, but the question is, well, what's the relevant piece of information for you? So that's where financial planning and investment management, that's the whole concept, right? Is that you take these large macro ideas that affect the entire world and then figure out, well, for me as an individual client, what does that mean? Am I looking to buy a house in the short term? Okay, well, I might pay a little bit higher of a price than I normally would because prices have gone up significantly as a result of a lack of inventory, which goes all the way back to the housing crash of 2007. But also interest rates are low. So maybe if I'm looking to buy a house in the next 1 to 2 years, I'm very interest rate sensitive, right? Maybe I decide to pull the trigger just because of where interest rates are and the concern that they could go higher as a result of the Fed tapering. If we're concerned about inflation and you're a retiree and you're thinking, well, man, Social Security is not going to keep up with inflation, savings is not going to keep up with inflation, then maybe you need to look at some assets that would actually move well with inflation, right? Consumer staples, for example, things that are going to continue to increase as prices in general increase. So there are things that can be done individually as a client that you need to think through for your specific circumstances. The goal of this video is just to make you aware of some kind of significant changes that have been discussed from a Federal Reserve. The old saying is you don't fight the Fed, right? So when Federal Reserve sets monetary policy, they're talking about something that is going to affect the entire global markets related to investments, interest rates, bonds, etc. And that's what investment portfolios are made up of. They're made up of those types of asset classes. So we want to be cognizant of what the Federal Reserve is doing, but also think about how does the data affect me personally as an individual saver or a young professional who's trying to build wealth or someone who's trying to plan for the future or manage income taxes. So I just wanted to make you aware of that. If you have questions, would love to talk with you about it. You can shoot me an email, josh@joshuaduvall.com, or you can reach out on my website, joshuaduvall.com. Thank you so much. I hope you have a wonderful day.